As the gold market continues to heat up, we've got more consolidation on the table, folks. The latest transaction will see Agnico Eagle acquire O3 Mining in a deal that will further consolidate the Val-d'Or region of Quebec. And in a rarity for junior mining investors, shareholders are set to receive cash rather than shares under the terms of the deal. This is always a huge plus for the mining world, because what tends to happen is that these deals set off capital flows into other junior mining names. All right, folks, today we're breaking down the Agnico Eagle purchase of O3 Mining. Let's dive in. All right, let's get the key points down here. Agnico Eagle and O3 Mining have entered into a definitive support agreement that will see Agnico acquire the Gold Explorer. The arrangement will see Agnico pay $1.67 for each share of O3 Mining, which amounts to a total acquisition price of $204 million on a fully diluted in the money basis. The figure represents a 57% premium for O3 shareholders based on the 20-day volume weighted average price of the equity. Under the terms agreed to by the two parties, the acquisition will occur by way of a takeover bid, which is a bit different than the standard acquisition method. Rather than conduct a shareholder meeting, shareholders of O3 are to tender their shares to Agnico once the gold producer issues a takeover bid circular. In simple terms, this basically means shareholders vote by committing their shares to the deal, rather than by raising their hand and saying aye at a meeting. This method of acquisition requires that at least 2/3 of shareholders, excluding Agnico, agree to tender their shares, which they have 35 days to do upon the issuance of the circular. At the time of announcement, directors and officers of the company representing 22% of outstanding shares had agreed to a lockup provision which tenders their shares in favor of the deal. And by the end of the trading day, Gold Fields, a 17% stakeholder in O3, acknowledged their support for the transaction, bringing total locked-in support to 39%. So why does Agnico want O3 Mining? Well, if you look at a map, it's pretty self-explanatory. Here you go. For those that didn't catch it, O3 Mining's flagship asset, the Marban Alliance, is right up against Agnico's massive Canadian Malartic complex. And this isn't just a case of Agnico going, okay, let's just grab some more claims here and maybe they've got something for us. Instead, they're basically stealing the asset. O3 has put in the work. Marban has a resource estimate that consists of 2.4 million indicated ounces at 1.09 grams per ton gold, along with 223,000 inferred ounces at 2.21 grams per ton gold. The company has also advanced the project along multiple stages of development, with a pre-feasibility study released in 2022 identifying that the project has a net present value of $463 million using a 5% discount rate, along with an IRR of 23.2% and a payback period of 3.5 years. That estimate is based on an operation with just under 10 years of mine life that would on average produce 161,000 ounces of gold a year at an all-in sustaining cost of $882 an ounce. Oh, and that's based on $1,700 gold. At $2,400 an ounce gold, the net present value jumps to about $1.1 billion, with an IRR of 43.3% and a payback period of just 1.9 years. And just to hit this home all the way, gold is currently trading in the range of $2,600 to $2,700 an ounce. So the economics are even better. And at $2,400 gold, the project is expected to generate $464 million in after-tax free cash flow in the first 2 years of operation. As a reminder, Agnico is paying just $204 million for O3. Those assumptions are also based on the construction of a 6 million ton per year mill for the operation. And who knows if Agnico will want to construct another mill rather than just truck the ore to Malartic for processing. On top of Marban, O3 also has some other assets which are basically kickers in this transaction. First, they hold the Quebec project to the north, which is currently early in the stage of exploration with some decent gold intersects, including 5.3 grams per ton gold over 5.5 meters and 13.7 grams per ton gold over 5 meters. They are in the midst of an 8,000 meter drill program here. They've also got the Alpha North project, which is down the road from Marban and boasts a resource estimate of 492,000 indicated gold ounces at 2 grams per ton, with 753,000 inferred gold ounces at 3.3 grams per ton. The project is just 3 kilometers from Eldorado Gold's Lamaque mine and is adjacent to Agnico's Akabasa West mine. Then there's even earlier stage stuff here, including the Horizon, Launay, Peacock, and Regcourt projects, which are all found in Quebec. And then they've also got a 13% ownership stake in Stellar Gold, one of the largest gold explorers in Canada, and a 14.2% ownership in Cartier Resources. Both of those companies have projects in the PEA stage, with the ownership interest worth about $15 million on a combined basis. Lastly, O3 holds 12% of Electric Elements, which is a private entity that was formed in 2023 that holds certain Osisko assets to create a lithium explorer. With all that being said, it appears that Agnico is getting an outstanding deal on the portion of the company that they don't own. In fact, the company currently holds $10 million in debentures that they acquired quietly last year, which contains a conversion right at $2.05 per common share. But the price to be paid is also a major pain point for current shareholders, many of whom acquired their positions at much higher prices. For reference, if you bought the stock roughly a year ago, you could have paid as much as $1.71 a share. And it only gets worse from there, with the equity trading as high as $3.68 back in October of 2020. It should also be mentioned here that in 2019, O3 Mining acquired Alexandria Minerals at an implied price of $3.88 a share, which the company never actually achieved on a post-transaction basis. As a result, investors, well, at least some of them, are pissed, with plenty highlighting the salaries of management as well as the golden parachute that some secured. At least analysts are positive on the transaction, though. So let's wrap it up. I'd argue that Agnico Eagle got a great deal here. They're paying about $64 per ounce in the ground for an asset that's right next door to one of their major operations. But when you think about the $204 million price tag, and then you back out the $26 million in cash on the balance sheet, as well as the $22 million in marketable securities that they had on their last financials, well, things get even cheaper. But I mean, here's the thing. If investors perceive the asset as being more valuable, well, they could have gone and bought the stock up, but they didn't. It's easy to get frustrated with a deal price, especially if you're a long-term holder, but Agnico Eagle is paying a 57% premium here in cash. It's unrealistic to expect a major to pay any more than that. Unfortunately, that's just how investments go. All right, everybody, thanks for watching. If you have any thoughts on the transaction, please let me know in the comments section. Also, if you enjoyed this content, please smash that like button, subscribe, and ring that notification bell. All right, everybody, thanks for watching.